I love real estate, but I don't put all of my money there. Almost one third of it goes to other things on purpose. So, in this episode, I'll tell you what those other things are, why I pick them, and how they help me build long term freedom with my money. Quick heads up, none of this is financial advice. This is just me, a guy on YouTube, sharing what I personally do right now so that hopefully it's entertaining and educational. Your situation might be totally different. So, do your own research, talk to a pro, and make decisions that fit your own plan. The first and most significant place I put my money outside of real estate is in equities or the stock market. And if you looked at it just by percentage, it's about 13% of my total wealth is in stocks and equities. I'd like that number to be even higher over time. So maybe 25% would be a number I'd be comfortable with. And, compared to many people who are primarily equity investors first, that would be a pretty low allocation. For those people, you might see people at 50%, 75%, even 100% stock. I'm a real estate investor first and foremost. So kind of like people who started a startup business where, Elon Musk started up or helped start or Tesla, and Jeff Bezos started Amazon. I'm very heavily invested in my startup, which was real estate investing. It was more entrepreneurial. And so I have a higher percentage, and I'm okay with that. But I would like to have equities. And my reason being, here, my philosophy behind owning stocks is I really think there's just two asset classes that I really want to have most of my money in, and that's stocks or businesses and real estate. Those are the two things that produce earnings over the long run. I'll show you some other investments that I have that are more speculative, that may do okay over time and own for different reasons. But I want a bulk of my money in businesses that are producing things, selling things that are productive. And the cool thing about the approach I'm taking, or at least my philosophy, why I think it's cool, is that I try to just be diversified over the entire stock market. So instead of trying to pick winners and saying this stock's going to be better than this one and trying to get in at certain times, I'm just long on the stock market, and I try to be as broadly diversified as I can. In my case, I have two index funds. I have VTI, which is an exchange traded fund by Vanguard, and that's just basically you're owning the entire United States stock market, like 4,000 plus companies, and it just tracks the index. So whatever the index of those companies is, you own a certain percentage of all of them. Like you own Apple, you own Amazon, you own all the big ones, and then you own all the way to some of the smallest publicly traded companies as well. And over time, that'll change. So some of those companies will go bankrupt, some will go bigger, some will go smaller, but I'm just going to always own the total stock market. And the same with international. So, whether this is a good strategy or not, I don't know. But my idea is that I want to be broadly diversified over the entire world. And the bet I'm making is that I want to have 75% of my stock investments in the United States, 25% international. So everything not in the US. And so I have this index fund called VXUS, another Vanguard fund. And the only active thing I have to do is trying to reallocate this. So this has actually not been perhaps not a great strategy over the last 10, 15 years because the United States stock market has done really well. And so that portion has gotten bigger and bigger for me. So as I've bought more stocks, I've had to buy more international stocks. And the point of having that allocation is you keep a fixed allocation that you think is reasonable over the long run. And then as US stocks do better, I buy less of that. I buy more of the international, which is supposedly cheaper relative to the United States. And you just try to keep that ratio over the long run. Now, again, whether that's the winning approach or not, I don't know. I'm comfortable with it. I like making the bet that I'm saying I think the entire world's stock market is going to do well over the next 20 years. That's my bet. My bet is that the best managers of 6,000, 7,000 companies over the whole world, that if they reinvest their earnings, because they do pay dividends, but most of the earnings they keep, that if they reinvest those earnings into more businesses and grow them, they're going to do better and better and better on the aggregate. I think that's a really good bet. So over the long run, like a 20-year horizon, which is mainly what we're looking at, because this is mainly for retirement account funds for us, is like a parallel investment approach that we're taking. We have our real estate stuff. There's more short term and also what we're trying to live on, and we build wealth with that. And then this is just sort of like a backup plan to that. That's totally not correlated with our local real estate that we own. And so approach diversified, low cost index funds. And so I like Vanguard. I like John Bogle's philosophy. He founded Vanguard on having low cost index funds instead of trying to pick actively managed funds where you pay somebody 1 or 2% to manage your portfolio, your mutual fund. That sounds like maybe 1% is not a lot, but over the long run, they have to not only beat the market, they have to beat that 1% fee that they're charging you, because something like VTI or VXUS has a very low expense ratio, like 0.07%. And so, almost nothing. It's getting super, super cheap. And so over the long run, it's very unlikely that any actively managed fund is going to beat these over and over again. The numbers are tiny, and for you to pick the winner of the actively managed fund that's going to do it is almost nil. So I like the diversified approach, and just my bet is I'm going to be the market. Whatever the market does, that's what I'm going to do. If it makes 6%, I'll make 6%. If it makes 10% or 12%, I'll do that. And it doesn't use much of my time, which is another big deal with this. I don't want to spend much time on it. I want to just let it roll. I want to spend time on my teaching, my videos, my real estate, my family, my travel. And this is just something that can be running in the background. So overall, 13% now, might go up over time, but those are my reasons for having stocks as one of the most important other investments outside of real estate. The second largest type of investment I have outside of real estate is simply cash, or some kind of cash equivalent. So if you listen to my channel at all, you know that I like to be pretty conservative with cash in addition to having real estate. Real estate is a great investment, but it's very illiquid, meaning it really takes a long time to sell it. Even a single family house, which I like, which is one of the most liquid real estate investments, could take months to sell, or if you had to sell it at wholesale price, maybe a week or two. So it's not like stocks where you can press a button, or cash, which you can take out of the bank. So I like this idea. It actually came from Nassim Taleb, where he wrote a book called The Black Swan and other books about being anti-fragile. And he had this idea of a barbell strategy where you have basically two different types of investments in your portfolio, one that's really risky, one that's super, super conservative, and then not as much in the middle. So real estate for me is the more risky or aggressive investment, stock market and equities as well. But then I always like to pair that real estate investment with a healthy amount of cash. Now, how much is healthy? That's a very personal decision. I have some other videos where I've talked about the places I put my cash in my real estate business. I like to have kind of like an emergency fund for real estate in case we have uncertainty. We call it like uncertainty insurance. There's a cost to having cash sitting in the bank. It's good. If inflation happens, you're losing the ability to, it's going to buy you less stuff in a year or two from now than it will today if there's inflation, which we've been having for a long time. That's the cost of having insurance. And what does that insurance buy you? It buys you the ability to be emotionally stable when times get rough, and they will get rough. Everybody has ups and downs. We're going to have economic recessions, maybe even a depression. We're going to have opportunities. We're going to have busts. That's just a certainty that's going to happen because we human beings are up and down people. Our emotions go up and down. And so this is another, you might have heard the term with like alcoholic drinks of liquid courage. I think about cash is like liquid courage. It gives you courage during trying times to make decisions like to hold on to your real estate, not sell it all, or to buy more real estate like in 2007, 8, and 9. But you can't do that if you're too over leveraged and you don't have enough cash. So the amount of cash you need is the amount that helps you sleep well at night, that gives you a big cushion, a margin of safety. And the choice of where to put it is pretty simple. Mostly for us is FDIC savings accounts. So insured by the FDIC up to the limits for either a savings account, a money market account. That's kind of the primary places we put it to. As savings grow and you get past some of those FDIC limits, there are some banks where you can like disperse it among different banks. That's one option. I also like the idea of putting them in U.S. short-term treasuries. That's like what Warren Buffett does when he has, I don't know how much cash they have, $150 billion or something at Berkshire Hathaway. They buy short-term, like 3-6 month U.S. treasuries, which actually these days in 2025 actually has been making some decent interest, like 3 or 4% interest. So, but you're not doing this because it's going to make a lot of interest. You're doing this for that insurance, for that liquid courage, for the ability to keep your emotions in check and be able to just deal with uncertainty and disasters and things that are going to come either on the negative side or also on the opportunistic side. So having some cash there, we have it in our real estate business. I have it personally. Have it in any business I run, the Coach Carson business, anything, have a pretty healthy amount of cash. And it served me well. It definitely served me well in 2007 and 8. We were able to actually withstand and survive that when a lot of other people I knew at my stage of investing didn't make it, primarily because of cash and being willing to pivot and adjust. So really important investment, I think, for my overall portfolio. The third place that I put my money outside of traditional real estate investing is into private notes and loans. And you might be able to consider this in the real estate investing world, because what this means is instead of being the owner of the property itself, you are essentially the bank for other people. You're the financing for other people. And let me explain what I mean by that here in a second. But for us, this is about 4% of our total. So not a huge percentage anymore. I think in the past, I didn't track it exactly earlier in our career, but this was a larger percentage of our total portfolio. And the reason being, we seller financed a lot of properties during the Great Recession, like 2008 and 9. It was one of our exit strategies. We had the strategy of turning renters into homeowners. So we'd start off with a renter, they would kind of build their credit or build their down payment in our case. And once they came up with 10% or 15% down, we would then finance the balance to them at an attractive interest rate for us. Maybe it was 7%, 8%. And then we might have seller financing from somebody else at 3 or 4%, or we might own it free and clear, just depending on the situation. But we would create these spreads, $300, $500, $800 spreads, where we were making cash flow on a monthly basis. And so that was a really nice way to take advantage of the short-term cash flow, because what I found, and you might have heard me say this on the channel, is that rental properties are kind of like fruit trees. You can plant this seed and it grows over time, but it takes like 5-10 years for it really to show its full potential. Like you plant a seed for an orange tree or an apple tree, you're not going to really harvest those oranges or those apples consistently with like the full load of fruit for a while. And rental properties are the same way. But by mixing in rentals that are good long-term plays with owner financing or notes over the short run, that it kind of was a mix of cash flow when we needed it, really to retire early or to have financial independence. And then later on, once the rentals kicked in and they grew over time, then we could depend more on the rental cash flow at that point. So that was our initial strategy. And while we probably have less of it today, although we still like doing that, we've also done some bridge loans, which are basically loans to other investors who it's a fixer-upper property and they can't go to the normal bank, or they just want to have faster access to money. So they're willing to pay a private investor or hard money lender or somebody else a higher interest rate just for the access to money on a fixer-upper property. But it's a short-term loan. It's a bridging between buying the property and getting a long-term loan, like a DSCR loan or a commercial loan or a conventional loan. So eventually we get paid off over a 6 to 12 month period. And so we do some of those here and there as well. So both of those, again, for the cash flow, is something I like to mix in. And for me, the worst case scenario is I'm a real estate owner. So if I have to take the property back, I'm okay with that. That's one of my criteria for making loans is I won't do a seller financing or a bridge loan if I'm not willing to take that property back at the price or the amount of money we're loaning on that property. So a good mix is something that you might not want to jump into right away if you're a brand new beginner. But if you're already an investor, mixing this kind of this type of investment in can be a really good complement to the other kind of investments you have. The fourth thing I put my money in outside of real estate are a category called alternatives. Now, this is my category to sort of play around with ideas or to speculate on ideas that I think have potential long run, but this is really a category that it could go to the moon or it could go to zero. And either one is possible. I'm not 100% sure of either one of those, but you can kind of think of it like taking a flyer where if things go great, you're going to do amazing. But if they go to zero, it's not going to ruin the rest of your portfolio. And this is something I've dabbled in more as I achieved financial freedom. And I wanted to diversify a little bit more. And I wanted to keep my interest. Like by me investing some money in some things, it allowed me to study them and learn about them. One of those has been Bitcoin. Now, again, this is like one of those love-hate things. Some people are just all about it and very enthusiastic about it. Some people think it's a scam and it's going to go to zero. Okay. I have invested enough where if it went to zero, it wasn't going to kill me, but it's actually done pretty well for me. And it started off at a lower percentage and has done pretty well over time. My thesis with Bitcoin is that I don't think it's going to take over all the world. I don't think it's going to be the primary currency people use. I think the dollar is still going to be around for a long time, and other kind of, they call them fiat currencies that the countries sponsor basically. But I think there's a place in an online world and an international world, and where there's plenty of use cases where having money that is not with that particular country has some value. Like I think I've traveled to South America a good bit, and in Argentina in particular. And I remember talking to people who owned a hotel or small business owners. I felt like the equivalent of what my business was, but in Argentina. And I would ask them, like, where do you put your money? Or tell me the stories about that. And where do you invest? And they told stories about these currency crises they had, where they had money, $100,000 in the bank, or 100,000 pesos in their case. And then the bank, all of a sudden there's a banking crisis, and you can't get your money out for a year or two. They just lock it down. You can't withdraw your money. And when you can get your money out a year or two from now, it's inflated so much because they had hyperinflation that money was, had lost 90% or 95% of its value, or some big percentage of its value. that's reality for a lot of places. Not every, we kind of take it for granted being in the United States or Western Europe, that there's a stability of currency and also a portability of currency. It's not always easy to go from one currency to another. So I think there's a role for that kind of thing, for in transmitting money from one country to another with low cost. And there's like some other kind of new technology coming along with that. So I think it's interesting, something I've played around with. I don't know whether it's going to do great or not, but I've invested in it a little bit. I also like to dabble with angel investing or private investments. This has been something the last couple of years. Like I invested in basically companies that I believe in and I think have a use case that I think is interesting. One is called Heroic Corporation. It's a personal development and coaching for basically kind of mixing positive psychology, like modern psychology, with ancient wisdom and stoicism. A guy named Brian Johnson, who I've followed for a long time. So I've invested in that early on, kind of in the early phases of the business, to try to help the business and also to follow along and maybe make a profit if it does really well. Also invested in another one called Kit, which is my email software. And I had an opportunity kind of to privately invest in that company as well. So those are, again, not going to make a huge difference if they do really well. Even so, it could do well. And it's importantly a small percentage of my overall portfolio, which is mainly real estate and equities and stocks. So let me do a little review of where we've come from with the 4 other types of investments. About 13% in stocks, equities, so very broad index funds over the entire world's stock market. About 8% in cash. I wouldn't mind that being a little bit higher. Sometimes it is, just depending on how their stuff's doing. Cash or cash equivalent, something you can access really quickly from a savings account, from a treasury bond. About 4% in notes for cash flow and being able to benefit from real estate and the security of real estate, but getting more cash flow from it. That's the financing piece of the puzzle. And then 3% in alternative investments. This is sort of my playground for some cryptocurrency, for some angel type investments. And all of those total up still, though, to a relatively small percentage of the overall portfolio, about 28%. And that might grow bigger over time. 72% is still direct ownership of real estate. And for me, that's either mainly through a partnership. I have a 50-50 business partner. We've been in business together for 22 years, and that's where we own a lot of our properties. And then personally, my wife and I own some properties that we used to live in and then kept as a rental property or personal residence as well. And so this is still where most of my focus, my effort, my wealth is in real estate, which is why I spend a lot of time on this channel talking about it. And I'm a big proponent of it. But what I want to hear from you, though, in the comments is, I'm constantly growing and learning. So this is, been something very personal about my own approach, but I'd love to hear from you. Like, how do you think about diversification? How do you think about investing in different types of asset classes? Let me know there if you have any suggestions or ideas. And if you're somebody who is an intermediate to advanced real estate investor, or you want to go all in on that, and meaning you have 1 or 2 properties or more, then this is what I teach and coach every single day. So if you want to go all in and get really good at real estate investing, I have a community and a coaching group called Rental Property Mastery. You can check it out. There'll be a link below at coachcarson.com/RPM. But what I do there is help you go direct to buy properties, to get the financing, to manage them. Buying the property is only half the battle. You have to actually keep the property to benefit from it long run, so that you actually have the time and the flexibility to travel and to do other things. And so if you're interested in that, check out Rental Property Mastery. I would love to hear from you. And if you have other ideas for future episodes, or if you found this topic interesting, it's a little bit off my main topic, but let me know what you think about it. And we'll be happy to bring some other episodes to try to help educate myself and educate you about the overall investment world. So thank you again for being here, and I'll see you in the next episode.